If you're starting your first company, understanding stock, preferred stock, options, convertible notes, and other fundraising instruments can be truly overwhelming. We actually didn't find a single video that covered this. So here we go. This is Fundraising for Startups 101. If you're an early stage startup in the tech space, and you're looking for money to grow your company, the official term for that would be raising capital. The most commonly recommended instrument to do so is called a convertible note. However, to understand how those work, we first need to understand how equity or stock works. By the way, if you're lost with any of the fancy words we're about to use, just rewind or check the video description for a glossary. Also, a shout out to our investors at Carao Ventures for validating our legal documents here. Okay, so stock. You're probably semi-familiar with the term stock. Stock is what represents the company ownership, and it's distributed in parts to reflect how much of the company each owner or shareholder possesses. Each shareholder receives a certain number of shares of stock. So the number of shares a person or entity owns in the company, divided by the total number of shares that have been issued, reflects that person's percentage ownership of the business. That ownership is often acquired with a cash investment, but it can also be acquired through other forms of value contributed, like your hard work. The percentage owned normally determines a shareholder's claim on the company's distributed profits. The term used here is dividends, and the voting power on certain key company decisions. But for you to understand better, we're going to use an example of a company we'll call FounderHub. Let's say that FounderHub has two founders who came up with the concept together and have both committed all of their professional time to develop this business. So they'll be equal partners. The co-founders, Walter and Jesse, go ahead and incorporate FounderHub. Startups are usually incorporated with about 1 million shares of stock. Why so many? Because it's complicated to break a share in half, and we'll get to that in a second. So after incorporating, each one of the founders owns 500,000 shares of stock, which represents 50% of the 1 million total. Most startups are incorporated as Delaware C corporations, and they just are. It's a legal structure that is most familiar to investors, it's easy to set up, it's easy to manage, and it's very tax friendly. So let's look at a priced round, raising money for stock. The traditional approach towards raising capital is with what's called a priced round, meaning a round in which both the founders and the investor are able to agree on an accurate valuation for the company. And so the investor gets shares of company stock in return for his investment. Let's imagine that FounderHub starts generating sales. It starts operating and things are going very well. Let's say that they're selling $10,000 a month and subscriptions are growing fast, so they decide to raise money. They calculate a nice round number of, say, $500,000 in an investment that they need to raise to accelerate their business. So they seek out an investor. Remember, companies rarely raise money without traction, and we made a whole video about that, so check it out. So how many shares do they offer an investor in exchange for those $500,000? That question really relates to the business valuation. How much is this business worth? If instead of FounderHub, Walter and Jesse owned, let's say, a car wash, its value would be calculated using a multiplier of their revenue or their profits. It's really their EBITDA, but who has time to explain what that is? If Walter and Jesse are making $10,000 a month, that's $100,000 a year, a traditional business could be worth maybe 1x or 2x this, depending on how profitable they are. This means that an investor could literally buy the whole car wash business for $250,000 or so, excluding the value of the land or the building. However, tech startups are different. Tech startups could have tremendous scale potential and fantastic margins. So it's extremely hard to measure how large and how fast can they grow in revenue and value. A software product or an app, for example, can realistically serve millions of customers around the world with a minimal staff. Think of Uber, who raised $500,000 on their first round and are now worth, well, close to $80 billion. They didn't need to invest billions of dollars on buying a car fleet, for example. So the value of a tech startup is not related directly to their current assets or revenues, but to their upside potential, their capacity to innovate and transform those innovations into value. Some variables to take into account here are, for example, the addressable market size. So how many customers are there for the company to serve, and how much would they be willing to pay for this product or service? Then the technology variable. Is there a unique piece of tech that nobody else has or that optimizes a process drastically? And then potential margins. How much does it cost me to serve an additional customer? For example, when Instagram had 300 million users, their staff was only 13 people. However, all these numbers are variables and estimates, and nobody really knows for sure. But based on them, along with some credible early results, the valuation of a startup is defined by how much potential an investor sees in the business, how risky it is, and how much upside do they expect in exchange for risking their money, just like a bet. So these days, an average valuation in Silicon Valley for a tech company like our theoretical Founder Hub could be around $4 million pre-money valuation. Again, this is assuming that this is a high-scale, high-margin business, not the car wash. So let's say that Gus, our investor, accepts these terms, and then he's willing to purchase a $500,000 chunk of this business as an investment. So simple math tells us that if the full company is worth $4 million, then $500,000 would represent around 11% of this company. We're gonna dig deeper into this. Okay, so remember Walter and Jesse both have 500,000 shares of this business, shares of stock. Typically, the original shareholders do not transfer or sell their shares. What's gonna happen is the company will issue new shares to Gus. In businesses, stock rarely changes owner unless the business is actually acquired. On the contrary, companies often issue new stock, which dilutes the original shareholders' percentage ownership. I'm gonna explain this in the easiest of ways. Let's say that if Walter and Jesse had one share each, they would each own 50% of a 2-share business. If the company issues a new share of stock to Gus, then everybody still has one share, but it's no longer 50% of the business, it's 33% of it. So in this case, for the math to work, Founder Hub will issue 125,000 new shares of stock to Gus. When the company does this, it'll no longer have 1 million shares. It'll have 1,125,000 shares. So Walter and Jesse will still own 500,000 shares each, but they will no longer represent 50% of the business, but around 44% of it. The new 125,000 shares issued to Gus now represent 11.11% of the company. The post-money valuation of Founder Hub is now $4.5 million. And this is why we had 1 million shares to start with, so that we don't have to issue fractions of shares. If the company would have been incorporated with only 100 shares, for example, 50 for Walter and 50 for Jesse, then it would have had to issue 12 or 13 stocks to Gus. So we would need to round up or down. That roundup could be worthless now, but a 0.01% equity stake in a company like Uber, that's actually $8 million today. Now, the challenge with raising money this way, a priced round, is that there are a lot of things to figure out. For example, how many votes does each share get in certain discussions? Usually, the standard is that you get 1 vote per share, but investors will often want more control over certain key company decisions, considering that they'll have a minority ownership in the company. If the company goes bankrupt, for example, and needs to liquidate assets, do investors get paid first? That's another thing that you have to agree on a priced round. Also, how does the board of directors look? Investors will often want to control a seat and to protect themselves against being removed from the board. Now, all of these decisions require negotiations, lawyers, signatures to be put in writing, and they can make the process take 6 months or more from the verbal, I agree to invest. Since most early companies don't have 6 months, they often choose to go with a convertible note. By the way, if you want to run your own calculations on this, you can download the free template that we've added at founderhub.io. A link is available below. Convertible notes. So a convertible note is an instrument that delays this valuation conversation, and it allows the company and the investor to agree and move forward on the investment much faster with less negotiation and fewer complicated, costly legal expenses. So a convertible note works a bit like a loan, but instead of using an asset like a house for collateral, the company's stock is the collateral at a valuation for the company that is going to be decided in the future. This means, obviously, that the investor also needs to believe in the business in order to invest, because it is the intention of the investor to convert this note into actual company stock. So like I said before, defining a company valuation is very tough. Too many uncertain variables, too little data. So with a convertible note, the investor is basically saying, I'll give you the money to grow now. In a year or so, we should have the data to support a priced traditional funding round. So my investment will convert then, using a formula that would be based on the valuation and terms that the company and the investor defined for such a future priced round. So as you can see, convertible notes could have some terms that could be hard to grasp. So we'll explain all of them through examples. So let's take case A. Walter and Jesse take the money from their first investor, Gus, on a convertible note. With the money, they grow as expected. Their business looks very healthy, promising, and 1 year later, they manage to attract a new investor, Madrigal, who is willing to invest $1 million on a price round that valuates the company at $5 million. When this new investment comes in, the convertible note with Gus is triggered. Now, to compensate the original investors for believing in this company early on, notes have an interest rate and a discount. So the interest rate is usually 5 or 6%, and the discount can range from 10 to 25%. That is a discount on the valuation set by the new investor. So in this case, again, Gus invested 1 year before Madrigal's round. So he's earned about $25,000 in interest. So when the day comes to close the legal paperwork, Gus will be converting $525,000 at a $4 million valuation instead of the $5 million valuation that Madrigal got. That is the 20% discount. After the note converts, Madrigal invests their $1 million at the $5 million valuation, and the new company distribution would look something like this. So let's look at another scenario. This is scenario B, where the company grows tremendously fast. In a couple of years, FounderHub finds a new investor that values the company at $50 million. Even with that 20% discount, Gus's valuation to convert is $40 million. So that original $500,000 investment plus interest would translate to less than 1.5% of the company. So the risk and upside trade-off that was taken by Gus by investing early was not really compensated in this investment for FounderHub. So this is why notes have a valuation cap. This cap is a maximum valuation at which the note will convert. So let's say that the agreed cap in this case for this investment was $7 million. So what would happen is that while the new investors will invest on a company valued at $50 million, Gus will convert his note at the cap, resulting in around 6x pay per return on Gus's investment, which is not bad at all. And the company would look like this. By the way, this same mechanism would apply if the company is acquired while the convertible notes are still withstanding. So the convertible notes would trigger their conversion in order to participate in the sale of the company. All right, so let's look at scenario C, our third scenario, the one that is less frequently discussed. What if the company doesn't grow? If the company can't raise any additional rounds of funding? So if the company doesn't manage to show tractions and attract new investors, and in this case, there's a maturity date for the convertible note. This is a date in which convertible note owners can convert their note and interest at the cap that we just discussed, or request a payback from the notes. Investors will probably request a convertible note payback only if the company can really afford it. And maybe they believe that converting at the cap is too expensive a valuation for what the company has become. So if the company can't afford to pay back the notes and the investors execute them, the startup will probably need to file for bankruptcy. The investors will also lose most or all of their money, since the company doesn't have the assets to pay back the notes. So using the same $500,000 example, maybe Walter and Jesse couldn't find a good product market fit, but they're still making, say, $500,000 a year in revenue. So what happens in these cases is that the company and the convertible note investors agree to one of the following. 1, extend the maturity date on the notes and continue accumulating interest. This gives the startup time and a chance to accelerate growth and maybe attract a new round of financing in the near future. Number 2, enter into a repayment schedule in which the company will pay the notes over a predefined period of time. By paying the note in multiple installments instead of just all at once, the company can afford to pay back without going out of business. Okay, so summarizing again, a convertible note is an investment with an interest rate, a cap, and a discount. The note is triggered or executed, ideally on a new round of funding, also ideally if the company gets acquired, or otherwise at a predefined deadline or maturity date, often 18 or 24 months after the original investment. At this point, investors can negotiate a note extension, they can convert at the cap, or they can request a payback. Again, usually if the company can afford it. Now, Y Combinator and 500 Startups have both designed documents inspired by the original convertible note, but even simpler to execute, which means you can get the money faster from investors, and they're free. The KISS, or Keep It Simple Security, and the SAFE, Simple Agreement for Future Equity, are simplified convertible note templates that you can use to raise money and skip some of your lawyer fees. Again, they both work as a convertible note, but they reduce a lot of your paperwork requirements. And the terminology on these documents is really the same that we've already discussed. So by now, you should be able to understand them no problem. You can also download both a SAFE and a KISS template from our Founder Hub site, and refer to the knowledge base for more details on how to complete them. All right, so we have videos coming up on the process of incorporating a business, distributing founder stock, and vesting. Do let us know which of these topics you'd like us to prioritize. And of course, if you found this video useful, help us out by subscribing and sharing, and we'll see you next week.